Welcome to this essential guide for beginner investors. Understanding different investment approaches is crucial for navigating the stock market successfully. Today, we will explore two fundamental strategies: value investing and growth investing. Each approach has its own philosophy, risk profile, and potential rewards. Knowing these distinctions will help you align your investment decisions with your personal financial goals and risk tolerance. Let's dive in. Value investing is a strategy focused on identifying companies whose stocks are trading below their intrinsic worth. The core philosophy here is a belief in market mispricing. Investors believe the market sometimes undervalues good companies for various reasons. Value investors seek to buy these stocks at a discount, expecting the market to eventually recognize their true value. This approach is often summarized as buying a dollar for 50 cents. It requires careful analysis to uncover these hidden gems. Key metrics are used to identify these potentially undervalued companies. The price to earnings, or PE ratio, compares a company's share price to its earnings per share. A lower PE ratio can indicate a stock is undervalued relative to its earnings. Another important metric is the price to book, or PB ratio. This compares a company's market value to its book value, which is its assets minus liabilities. A low PB ratio might suggest the market is undervaluing the company's assets. Dividend yield is also considered, representing the annual dividend payments relative to the stock's price. Companies with consistent, high dividend yields can be attractive to value investors seeking income and stability. These metrics help paint a picture of a company's financial health and potential undervaluation. Value investors typically adopt a patient approach. They are comfortable holding investments for the long term, sometimes years, waiting for the market to correct its mispricing. They are not swayed by short-term market fluctuations. They are also comfortable investing in companies that might be temporarily out of favor or facing short-term headwinds. Their conviction comes from their thorough research into the company's fundamentals, not popular sentiment. This long-term perspective is a hallmark of value investing. One of the main advantages of value investing is the potential to buy assets at a significant discount. This creates a built-in margin of safety. If the company performs as expected, there is less downside risk because you bought it cheaply. This margin of safety provides a cushion against unexpected events or minor miscalculations. When the market eventually recognizes the company's true value, the stock price appreciates, leading to substantial returns. It's about patience paying off. However, value investing comes with its own challenges and risks. It requires thorough and diligent research to accurately assess a company's intrinsic value. This is not a passive strategy. There is also the risk of identifying value traps. These are companies that appear cheap based on metrics but remain cheap for a fundamental reason, such as declining industry prospects or poor management. A value trap can tie up capital indefinitely without appreciation. Growth investing, in contrast, focuses on companies with high growth potential. The core philosophy here prioritizes businesses expected to grow their revenues and earnings at a faster rate than the overall market. Current valuation metrics are often less of a concern. Growth investors are primarily focused on the future prospects of a company. They seek out innovative businesses poised for significant expansion. They believe these companies will become much larger and more profitable over time. They are often willing to pay a premium for these stocks, anticipating that future earnings will justify the higher price. The expectation is that rapid growth will lead to substantial stock price appreciation, even if the company is not currently profitable or has high valuations. It's an investment in future potential. Growth investing is commonly found in specific sectors and industries. Technology companies are a prime example, with their rapid innovation and market disruption. Healthcare and biotechnology also feature prominently, driven by new discoveries and treatments. Other rapidly expanding or innovative sectors, such as renewable energy or e-commerce, also attract growth investors. These industries are characterized by dynamic change and significant opportunities for expansion. They offer fertile ground for high-growth companies. The primary advantage of growth investing is the potential for exceptionally high returns. When a growth company succeeds in expanding rapidly, its stock price can skyrocket, delivering significant profits to investors. Early investment in successful growth companies can be transformative. However, growth investing carries a higher risk profile. Growth stocks can be highly volatile, experiencing sharp price swings based on market sentiment or news. Their valuations are heavily reliant on future expectations, which can be uncertain. If a growth company fails to meet its ambitious growth targets, its stock price can plummet quickly. This makes growth investing more susceptible to market sentiment and changes in the competitive landscape. A shift in consumer preference or new competition can severely impact a growth stock. The high valuations often associated with growth stocks mean there is less margin for error. Any stumble in execution or slowdown in growth can lead to a significant reevaluation by the market. This strategy demands careful monitoring and a strong belief in the company's long-term vision. Deciding between value and growth investing, or a combination of both, ultimately depends on your individual circumstances. Your investment horizon, risk tolerance, and financial goals are key factors. There is no one-size-fits-all answer. Value investing might be more suitable if you have a long-term investment horizon. This allows you to patiently wait for undervalued stocks to reach their intrinsic worth. It also suits those with a higher tolerance for temporary volatility, as value stocks can remain out of favor for a while. If you prefer a more conservative approach, value investing offers a margin of safety. It can also be appealing if you are seeking income through dividends, as many mature value companies pay regular dividends. This strategy prioritizes stability and fundamental strength. Growth investing, on the other hand, is often better suited for investors with a higher risk tolerance. You must be comfortable with the potential for significant price fluctuations and the possibility of substantial losses. A longer time horizon is also beneficial, allowing growth companies time to mature. If you desire potentially higher returns and are willing to accept greater risk, growth investing could be for you. It requires a strong belief in the future prospects of specific industries and companies. This strategy is for those who are excited by innovation and disruption. Many successful investors actually employ a blended approach, combining elements of both strategies. This allows them to diversify their portfolios, mitigating some of the risks associated with relying solely on one strategy. A blended approach can capitalize on different market opportunities. For example, an investor might allocate a portion of their portfolio to stable, undervalued companies for a margin of safety. They could then allocate another portion to high-growth companies for potential outsized returns. This balance can provide both stability and growth. The key takeaway is to align your investment strategy with your personal goals and risk tolerance. Understand the principles of each approach thoroughly. Then, choose the strategy, or combination, that best fits your financial objectives and comfort level. Educating yourself is the first step towards making informed investment decisions. Continuously review your strategy as your financial situation and market conditions evolve. Your investment journey is unique, and your strategy should reflect that.